Welcome to this explainer. Today, we're going to explore why sustainability is no longer just about, saving the planet, but fundamentally about protecting an investor's balance sheet. We're taking complex, shifting frameworks and breaking them down into something you can actually use. Specifically, we're unpacking an absolute game changer in the world of corporate reporting, the executive summary of the brand new IFRS S1 and S2 standards. We've got a ton of ground to cover today, so we'll be moving quickly through 5 key areas. First, the investor's climate dilemma. Second, the massive value of comparable data. Third, we'll actually dive into IFRS S1 and S2. Fourth, we'll break down physical versus transition risks. And finally, we'll look at the 4 pillars of S2. Let's get right into it. Kicking things off with Section 1, the investor's climate dilemma. We really need to look at this from the perspective of the people actually funding these businesses. Because honestly, if we don't understand the motivation of the capital markets, none of these reporting standards are going to make any sense. So we have to ask ourselves, why are hard-nosed institutional investors suddenly so hyper-focused on environmental, social, and governance data? For a really long time, the assumption was that sustainability reporting was just a PR exercise, right? Just a nice to have. But I'm telling you, that era is completely over. Today, sustainable investing literally means combining those ESG factors with traditional financial metrics to figure out where to park capital. And it boils down to this crucial point. It is a legal and ethical obligation. Institutional investors have a strict fiduciary duty to protect future cash flows from hidden, unmitigated risks. They aren't digging into climate change out of the goodness of their hearts, They're looking at it because ignoring these risks would be a massive failure to protect their beneficiaries' money. We're not talking about abstract concepts here. We're talking about direct, measurable hits to a company's valuation models and long-term performance. Things like skyrocketing insurance premiums, entire supply chains wiped out by floods, massive new environmental taxes, or social issues that create instability and completely kill returns. Investors are using this data to screen companies out, tweak their valuation models, and fundamentally decide who gets capital and who doesn't. Moving on to Section 2, the value of comparable data. So now we know exactly why investors are desperate for this info. Let's look at the massive roadblock they've historically faced when trying to actually get their hands on it. For years, this space was an absolute mess. Reporters struggled with this cluttered, fragmented nightmare of frameworks. GRI, TCFD, CSSB, SASB, it left investors totally bewildered. It was practically an alphabet soup of standards. You'd have one company using one framework, their direct competitor using another, and some guys just making up their own metrics entirely. Total chaos. Think about it. If you're an investor and you want to compare the climate resilience of a company in London to a similar company in Shenzhen, you absolutely need an apples-to-apples baseline. Without a cohesive standard, sustainability reports were basically impossible to compare. Investors literally couldn't tell if a company was genuinely mitigating risk or if they were just cherry-picking the data that made them look good. Which brings us right to Section 3. Enter IFRS S1 and S2. Realizing this absolute crisis of comparability, the market essentially demanded a unified approach, and the IFRS Foundation stepped up to provide the solution. And man, they moved fast. The newly created ISSB rapidly scooped up all those legacy frameworks and consolidated them to create a single, common language for sustainability information that actually matters to global investors. By merging those older boards into one powerhouse, they officially published S1 and S2 in June 2023, kicking off voluntary application right at the start of 2024. S1 is really your overarching baseline rulebook. And what's fascinating is that it applies globally, completely regardless of whatever accounting standards a company happens to use. It basically sets the general rule that companies have to disclose all sustainability-related risks and opportunities that could reasonably mess with their cash flows, access to finance, or cost of capital, whether that's in the short, medium, or long term. All right, Section 4, Physical and Transition Risks. While S1 lays down the general groundwork, IFRS S2 drills down specifically into climate. It requires companies to lay all their cards on the table regarding their climate change risks and opportunities. Investors desperately need to know, are a company's assets facing literal physical risks, like acute storms wiping out coastal warehouses or chronic droughts permanently halting agricultural production? On the flip side, they need to know about transition risks. Are policy changes or new green technologies going to make a business model totally obsolete? Think about it. If a new law bans gas-powered cars and that's all your factory makes, that is a gigantic transition risk. To really measure that transition risk, S2 demands that companies show their math on greenhouse gas emissions across 3 very specific scopes. Scope 1, that's the pollution coming directly out of your own smokestacks. Scope 2 is the indirect emissions from the power plant generating your electricity. And Scope 3 is the big one. That's your entire value chain, upstream and downstream. This forces transparency so companies can't just outsource their dirty work and pretend they're fully green. Finally, Section 5, the 4 pillars of S2. So, how on earth does a company organize all this incredibly complex risk data without it devolving right back into that chaotic alphabet soup? They need structure. Well, IFRS S2 mandates that companies structure their disclosures using 4 distinct logical pillars. Now, if you were familiar with the old TCFD framework, you're going to recognize this structure immediately because the ISSB brilliantly decided to build upon it rather than forcing everyone to start from scratch. It really creates a perfect narrative flow. First, governance. Tell the investor who is actually in charge of this stuff. Then, strategy. What's the game plan for the transition? Next, risk management. Exactly how are you identifying and monitoring the ongoing threats? And finally, metrics and targets. Show us the hard numbers. It forces a company to prove that sustainability isn't just a side hustle for the PR team, but a core strategic objective managed at the board level. Because here's the reality. With the rollout of IFRS S1 and S2, the days of relying on vague, fluffy environmental promises are completely over. Investors are now demanding comparable, verifiable proof. The global baseline has arrived. So the question I want to leave you with today is this. As these standards turn voluntary disclosures into hard, verifiable financial data points, is the business you invest in or work for truly resilient enough to survive the transition? Thanks for hanging out and exploring this with me today. Keep asking the tough questions, and I'll catch you in the next explainer.